If you're somebody who's buying a business or you're looking to sell your business, make sure that you heed this very closely, because we're in a time where there's an invisible force in the market that will determine your success in running a new business after you buy it or you raise money to buy it. And that little known secret and little known market effects is the interest rate. Because we can talk about how great we are at buying businesses and at managing businesses, when we raise money to buy businesses. But the little known thing, especially if you're buying a business with real estate attached, is the fact that interest rates have gone down at the time of the recording of the video. And when in the future the interest rates go down, you have to understand that now is a really good time to look at how long the term of the loan on the business that has been acquired is. That term on that business can determine everything. It determines how far that business can have a sloppy business plan and how much profit it can make. Because if there's like long-term debt attached to a business and the debt was acquired at a time where interest rates were really low, then you're good. If the business got the loan at a time when the interest rate was really high, and now that the interest rates are going low, it could be a time to refinance that debt attached to the business. And so one of the quickest ways to refinance that debt would be to look at the terms of the lender, look at the terms that you have, number one. Number two, calculate the pro and con of exiting that agreement. Look at if there's any penalty and the prepayment penalty or the penalty of exiting that agreement early or at the time that you need to, and then compare that to the savings that you'll make if you just get another loan with lower interest rates. So if you're able to do this, then you could calculate and see how different how much you'll lose by refinancing versus how much you lose and keep by not refinancing. And don't do it yourself if you're not somebody who's experienced in building financial models and who's been trained in all this. Get a CFA or a CPA that's trained in this, that does this for a living, so that you'll be able to do it the right way. And it's pretty affordable to get a CFA or CPA to do this. So in short, make sure, number one, just to recap, number one, make sure when interest rates are going down and you're looking to raise money to buy a business or buy real estate, look at the long-term debt that's attached to that asset. Number two, if the debt is at a high interest rates, calculate the benefits of refinancing. Refinance just means to switch out the loan, basically. They always try to make things complicated. Calculate the benefit of refinancing by looking at the contract's terms of exiting that agreement early. If there's a prepayment penalty, if there's a penalty for exiting early, if there's a penalty for paying down if there's a penalty for leaving that first loan, compare that to the benefit of switching to the lower interest loan. And then if, based on that calculation, that you get a CFA or CPA to do, it is better to refinance than refinance. If not, then don't. And that's pretty much it. That's the standard operating procedure. That's the instruction. Write those instructions down and then add it to your business buying or real estate buying process when you're raising money to buy these assets. And if you'd like this video and you want to see what else people can do, just make sure you head to raises.com and get a free consultation. And if you want to support the sharing of information to empower people to buy businesses with other people's money, head to raises.com, share this video, like this video to learn more. So we'll see you in the next one.